Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. Well, in this installment, we are going to talk about a very powerful investment idea, especially as it relates to retirement income planning, that I referred to as the investment quilt. Yes, the investment quilt. So it's a way of trying to connect the dots between your retirement plan and your investment plan. It's a very powerful way of looking at your portfolio so that you're doing the right things to have a high probability of achieving your goals without taking unnecessary financial risk on your portfolio. So before we get into the video content, if you're new to our channel, make sure you hit the subscribe button so you don't miss future content. We post content all the time on various aspects of retirement income planning and overall wealth planning. And if you are within 5 years of retirement, maybe already retired, and you want a second opinion about your current plan to see whether you're tracking in the right direction, in the show notes is a link to our homepage where you can find out how you can get a complimentary retirement income planning forecast and second opinion. Okay, let's talk about the investment quilt. So let's take a look at the investment quilt. The investment quilt is a very important idea as it relates to retirement income planning because, like I said in the introduction, it connects the dots between your plan and your portfolio. So here's the reality for most retirees. They can't afford to have all their money in risk-free assets. Now, when you talk about risk doesn't mean losing your capital. Risk does mean, when it comes to investing, variability of your return experience. So in order to reduce the variability of return experience, you should be embracing some level of investment diversification on your portfolio to smooth out the returns, to reduce the short-term fluctuation. And that's where the investment quilt idea comes into play. So let me just show you a great chart that was put out by CI Global Asset Management. And they're talking about the case for diversification. Let me just read you the introduction here. It's nearly impossible to predict what asset class will generate the highest returns in any given year. Investors benefit from diversification and reduce their risk by allocating to a variety of asset classes. A strong financial plan will incorporate investments into different asset classes that react differently to ensure investors reduce their overall risk. So the idea here is to have a mix of investments that will track you in the direction of your return objectives, but to smooth out the return experience because you have a mix that hopefully will be negatively correlated. And what they mean by that is that as some investments may be doing poorly, hopefully you have other investments in the portfolio that'll be holding their value or even making money during that period of time. Now, in the example that they've put together here is a great example of a balanced portfolio. Now, when we talk about a balanced portfolio, often what gets referred to is a portfolio that's roughly 40% income investments and 60% growth investments. And that's what this portfolio is, but it's actually made up of all these different investments in the portfolio. Now, the weighting to the portfolio will be those broad categories: bonds 40%, stocks 60%. But let's just take a look at the chart for a second. So the balanced portfolio that I'm talking about is the shaded boxes here in white. This chart, when you take a look at it, takes a look at the major investment categories. So just talk about a few of them: Canadian equity, large cap, Canadian small cap equity, U.S. equity large cap, and the list goes on. We then see emerging market investments on the stock side, global real estate, Canadian fixed income, global fixed income, high yield fixed income, and then we have the balanced portfolio. Each of these investment categories are color-coded. And then we have each year from 2000 through to 2022. And what the chart's illustrating is the return of each of these investment categories in every single year of this chart, going from 2000 to 2022. And then at the end, we can see how each asset class did in terms of their average return over that 10 years, and then the 10-year volatility. So which investments were the most volatile, which investments were the least volatile over that time period. Now, when you take a look at this chart, the first thing that I draw your attention to, if we step back a little bit, there's quite a bit of variability to it. So it's very hard when you step back to really be predictive about how asset classes are going to perform over time. And that's the challenge, right? You could take a look at last year's winners and expect that they're going to do very well this next year. That's the natural psychological default that investors often have, particularly novice investors. But very often, it's actually the contrarian approach that works best, that those asset classes that have the worst performance are likely maybe some of the asset classes that you should consider investing in. But here's the bottom line, and this is a very important part of the presentation. For most investors who are planning for retirement or living during retirement, their goal, generally speaking, is not to hit the lights out in terms of performance. They're not trying to be super aggressive and scoring a major home run on their portfolio. In fact, most investors for retirement, their default position is, I don't want to take any more financial risk than is necessary to achieve my goals. If I could put all my money in a guaranteed investment certificate, I would do that. But because that's not a practical reality for most people, they then have to go to a balanced portfolio. But they want to moderate risk, and the way you do that is through a diversified strategy. That caps the portfolio on the upside, but it also caps the portfolio on the downside and gives you hopefully a satisfying overall return experience that's in line with your financial plan. So I'll give you a good example. Over the last decade, if you look at most balanced portfolios, their returns have been in the range of 6 to 7% compounded returns for those investors, in an environment where inflation averaged probably about 2%. And in fact, if you look at the risk-free investment over the last decade, that was about 2%. So most balanced portfolios, depending on when you entered the market or left the market, provided returns that were 2 to 3 times greater than the risk-free rate. But here's the trade-off that you have to go through from time to time. So again, when we go back to the investment quilt, you can see there's a high degree of variability between the different investment categories. And so if you tracked fixed income, which is the purple here, it was the second best asset class for 3 years in a row between 2000 and 2002. And then it had subpar performance relative to other investment categories in 2003, 2004. And then it was back up, relatively speaking, in 2007, 2008. So you can take almost every investment category and see quite a bit of variability in terms of its performance. So the idea is, let's try to take the extremes out and build a portfolio like a pension plan that is correlated such that it takes the highs and lows out as much as possible. Now, a balanced portfolio still is going to fluctuate, but it's going to fluctuate less dramatically relative to the other investments in the portfolio. So again, if we look at this chart, you can see the white, which is the balanced portfolio, sort of cuts through the middle of all the noise and volatility over all these years. And in fact, if you look at the image that's on your screen right now, it's an image that's designed to, demonstrate the concept of cross-correlation or negative correlation when you build portfolios. This is what pension plans do when they're constructing portfolios. You have a mix of investment categories. We've got 2 on this particular image. And you would try to pick categories that fluctuate inversely to one another to smooth out the return pattern. Over time, the portfolio will go up in value. But you can see, for an example, one part of the portfolio is going up, another part of the portfolio is going down. A classic example of that with portfolio construction is bonds and stocks. Now, this doesn't always work this way, but generally speaking, when stocks are going down, bonds are holding their value or going up in value, and vice versa. And so you add bonds or real estate or even cash assets to portfolios to smooth out the variability of return so that you can still get satisfying returns close to your benchmark or what you're shooting for, while at the same time not exposing yourself to excessive risk. So when you look at the investment quilt, that's essentially what we're trying to do. We know there's going to be variability. How do we leverage off that variability to get the returns we're aspiring to, while at the same time reducing short-term risk, which is volatility, not loss of capital, just fluctuation of return. And so that's what you're trying to achieve. You're trying to take all the extremes, all the drama out of the portfolio as much as possible, and have a portfolio that, historically speaking, when you look at its performance and how it's done through good markets and bad, will be driving returns that will be commensurate with what your financial plan is calling for. And so you'll construct a portfolio made up of all these investment categories and weighted in such a way that it's consistent with your target for return and target for risk. So your mix of all these different investment categories will be a function of those 2 things. For more aggressive investors that have a longer time frame, they might have more money in the stock market. For more conservative investors who want less risk in their portfolio, they may have more money in fixed income or cash equivalents. So it's a very specific, situationally specific calculation about how the portfolio is going to be constructed. But once it constructs and it's put together, this is what the experience is going to be. This is a balanced portfolio, and you can see that over the long term, that 10-year average, the portfolio was 4th best of all asset classes, and it was one of the lower risk investment categories to be involved in. So that's the basic idea of the investment quilt. The idea is you are a retirement investor you're trying to fund your retirement goals. You'll use your financial projection for retirement to define how much return you need. That will define your investment mix for your portfolio, and then you'll leverage off diversification to try to get that return for the least amount of risk. The other thing that you'll want to have happen is that your portfolio gets rebalanced. So there'll always be good performing assets and bad performing assets through an economic cycle. Doesn't mean the asset's bad, just means that they don't perform well all the time, and you want to make sure that you're rebalancing. A good example here is that during times when the bond market was doing really well, you want to see rebalancing of assets going into assets that weren't doing as well. So you can see here in these years, U.S. big cap stocks weren't doing as well. Bond market was doing well. You'd want to see allocations of assets back to these underperforming assets. And by doing that, you will exponentially increase the long-term growth in your portfolio. It's a classic, sell high, buy low between different investment categories in your portfolio. Anyway, that's the idea of the investment quilt. Very important cornerstone part of investment planning for retirees. And again, if you enjoyed the video, click like. If you want to get future content, make sure you subscribe. And if you're looking to get a second opinion on your portfolio, your retirement income plan, whether you're 5 years out for retirement or already retired, make sure you go to the show notes for the link to our homepage where you can find out how you can get a complimentary retirement forecast and second opinion. You take care. Bye-bye.